Peter Lynch used to joke that if you spend 14 minutes a year analyzing the macroeconomy, you've wasted 12 minutes. For us rule number one investors, that sentiment rings true. However, that doesn't mean we turn a blind eye to the big picture. While we never let macro trends dictate our buy or sell decisions, they absolutely define the terrain our businesses have to navigate. More importantly, macro volatility is often what hands us incredible buying opportunities on a silver platter. Looking at it now, 2026 is setting up to be one of the most intriguing years for the macroeconomy in ages. From the tug-of-war on interest rates to fracturing global trade and mounting government debt, there are massive currents moving beneath the surface that every investor needs to recognize. In this video, I'm going to break down the 5 macro forces that I believe will define the stock market in 2026. But more than that, I'll explain exactly what they mean for long-term, value-focused investors like us. Let's kick things off with the topic that has dominated the headlines for the last year: interest rates. In the investing universe, interest rates are the ultimate landscape shaper. They dictate the short-term pricing of essentially every asset class: real estate, bonds, and certainly stocks. And let's be honest, short-term price action is the only thing Wall Street truly cares about. Warren Buffett famously compared interest rates to gravity. When gravity is heavy, rates are high. It pulls asset prices down. When gravity is light, prices float upward effortlessly. This year, we saw a massive struggle between two opposing economic forces. On one side, the general economy appeared to be cooling down with the exception of the AI sector, which signaled the Fed should cut rates. On the flip side, employment stayed low, the market hit all-time highs, and consumer spending remained robust, all of which signaled the Fed should hold steady or even hike rates to cool the engines. So, with all that confusion, should we care? No. Buffett has said that even if the Fed chairman whispered their 2-year rate plan into his ear, it wouldn't change a single thing he does. The only takeaway we need is this: a wonderful business must be able to generate massive cash flow regardless of the interest rate cycle. This is exactly why we insist that great businesses shouldn't be loaded up with debt. Our job isn't to gamble on rate predictions. Our job is to hunt for businesses with pricing power and simply wait for Mr. Bear Market to panic and offer them to us at a discount. The second macro giant is inflation. Simply put, inflation is price increases caused by the money supply growing faster than productivity. It is a silent killer for savers because savings account yields rarely keep up with the inflation rate, meaning your purchasing power erodes every single day. This forces money into speculation, driving up assets like real estate, gold, commodities, and stocks, as that excess cash desperately seeks to store a value. If inflation spirals out of control, something that has plagued every major empire from Rome to Britain, the currency eventually gets devalued. We've seen this happen twice in US history. First in 1934, when Roosevelt used an executive order to devalue the dollar against gold by 40% overnight, confiscated domestic gold, and then bought European gold at the new higher price. The second time was in 1972, when Nixon severed the dollar's link to gold entirely, devaluing it against gold and other currencies. Since then, the dollar only holds up because other nations are printing money just as fast as we are. The engine driving this modern money printing is US debt. It has ballooned so rapidly that interest payments on that debt are now the single largest budget item outside of Social Security. This is critical. The US is now effectively printing money just to pay off old credit cards. They call it deficit spending, but it's really just buying things you can afford with printed cash. No country can do this forever. Eventually, rates must rise to cover the risk of lending to a flaky borrower, and inflation eats away at the currency. We aren't at the cliff's edge yet, and no one knows how this monetary experiment ends. It might be a crisis, or it might just be a chronic headache we learn to live with. But we should never bet against inflation. Does this matter to us? Absolutely. This is why a non-negotiable trait of our target companies is the ability to raise prices along with inflation. We need businesses with wide moats that allow them to pass costs on to customers. Look at Coca-Cola. If sugar prices spike, Coke raises its prices, and people keep buying. They've done it for a century. A great business is inflation-resistant. Stick to that quality and you'll be safe. And if the dollar truly gets crushed, you'll be thankful you own great businesses. They will survive and operate in whatever the new currency reality is. Buffett put it best: if he had to choose between owning all the world's gold or owning businesses of equal value, he'd take 18 ExxonMobils and all the farmland in America. You can't eat gold. Never forget that. The third factor is the consumer. We actually have a live case study of what happens when consumption stalls. China. The collapse of real estate prices there created a negative wealth effect. Families felt poorer, so they tightened their belts. This caused corporate profits to plummet, which in turn dragged down the entire Chinese stock market. While the US hasn't faced a property crash, the average family balance sheet is bleeding. The surplus savings from the pandemic are gone. Credit card debt has hit all-time highs. And with rates staying up, mortgages are eating a larger slice of monthly income. If the US consumer pulls back in, we are seeing the early warning signs. It will ripple through retail, tech, and housing. When earnings forecasts drop, Wall Street reacts violently. Prices adjust instantly, creating volatility. We've seen this recently with some of our favorite companies. While a slowdown is painful for the economy, For investors like us, it means the prices of wonderful businesses start drifting down into our buy box. That is exciting. In a slowdown, we stop worrying about short-term growth and focus on durability. We want moats, pricing power, and low debt. If you know what you're doing, a consumption slowdown is your chance to build generational wealth. This leads to perhaps the most significant structural shift, the end of globalization. The US and Europe are actively decoupling from China, bringing manufacturing back home. China is doing the same. It is a global retreat from globalization, changing how things are made and, crucially, what they cost. This shift is pushing the US toward potential conflict with China, specifically over Taiwan. Why Taiwan? It's been part of Chinese history for 500 years. But today, it is home to TSMC. This single company manufactures the chips that run our phones, cars, and data centers. More critically, nearly 90% of the world's advanced AI chips come from Taiwan. If that export line is cut, the growth narrative for AI and the magnificent 7-inch stocks freezes instantly. Since these 7 companies have driven the bulk of market returns recently, if their story breaks, the whole market could crash. As chaotic as that sounds, remember, a crashing market is the only time we get to buy amazing companies at wonderful prices. Finally, we have to talk about artificial intelligence, and whether investors will finally distinguish between the hype and the reality. Elon Musk believes AI will generate so much wealth that worries about rates, inflation, and consumption will disappear. We'll live in a utopia of abundance with humanoid robots and AI tutors. I hope he's right. That sounds wonderful. But as investors, we need to protect our downside. We must focus on businesses that AI cannot disrupt just in case this is a bubble. We want businesses that utilize AI to become more profitable, not businesses that AI will replace. Betting on companies that rely on creative destruction to survive is a dangerous game requiring immense technical expertise. Unless you are an AI expert, you are far better off owning boring businesses. Companies with products that don't need to change. Think Coca-Cola, Sprouts, Chipotle, or Netflix. Rule number 1 is about staying within your circle of competence. It is much easier to understand a burrito or a beverage than a tech stack that has to reinvent itself every 6 months to survive. Remember, we invest in businesses with durable advantages and proven track records. If we stay disciplined focusing on strong cash flow, real moats, and simple products bought at a discount, we are going to do great. And we will maintain the one asset that is priceless in a crazy world, peace of mind. If the idea of great returns and peace of mind sounds appealing to you, I'd love to invite you to my upcoming 3-day investing workshop. We are broadcasting live from my studio in Peachtree City, near Atlanta. You'll be learning directly from me and my coaches. We'll show you how to analyze businesses, value stocks, and turn this macro chaos into a long-term strategy for wealth. The time to act is now. Grab a free ticket by clicking the link in the description or the pinned comment, or just scan the QR code on the screen. We aren't selling anything at this workshop. We are just there to teach. Take advantage of this, guys. We'd love to see you there.